question for the Aussie share market, and we did start off the session quite negative, as you can see from the intraday graph behind me, but we improved as the day went on. And the big thing that impacted on our market in the afternoon was the fact that we've seen China's market coming back online after a holiday yesterday, and we have seen a very strong performance by the Shanghai Composite. In fact, it's up by 1.8%, so that helped a lot of our miners and helped the Australian market to a flat even here in Australia. Some of those smaller tech-based high growth companies also have very strong valuations as well. For example, if we have a look at Freelancer, that has a PE ratio, a forward-looking PE ratio of about 1100. If we have a look at Xero, well, that one's not even making a profit yet, so you can't even work out a PE ratio for that particular company. And REA Group has a PE ratio forward-looking on a consensus basis approaching around about that 50 mark. So those type of stocks have still been sold off quite heavily. In fact, if we have a look at Xero over the last couple of sessions, it's down by 17%. We have a look at Xero, it's down by 14%, and we've seen REA Group down by about 7%. So still a very strong focus on those growth momentum type stocks, but they do tend to be smaller companies. So it was a small ordinaries index which was down by 0.5%. The rest of the market looking quite flat. Of course, looking ahead, we are now watching US earnings season, and we will see the first quarter earnings season kicking off tonight with Alcoa. Overall, the earnings season is expected to see earnings down by 2.6% compared to the previous year, but revenue up by 1% and margins just coming down slightly. If we have a look at Alcoa, expectations are for an earnings per share result of 5 cents. That's down from 11 cents in the previous corresponding period, and on revenues of about $5.56 billion. So that's the one that we'll be watching tonight. We'll be watching earnings season kicking off, and especially that US stock performance, because it is jitters over valuations and earnings. Those high momentum stocks being sold off really heavily over the last couple of sessions. The PE ratio tells us just one thing, and that's whether a stock is cheap or expensive according to earnings. Now, just because a stock is expensive does not make it a bad investment. What it does tell you is that you're paying a premium now. And if you're paying a premium now for the company, what you want in the future is greater growth. You want greater growth in the market. So there's an expectation around greater growth. And if you're going to see that growth come through, there's no problems with paying a premium now for a good company. The problem becomes when you pay a premium and that growth doesn't come through. And that's the problem with some of these high PE ratio companies. I mean, just have a look at the healthcare space. CSL has always had a very high PE ratio multiple, but the share price and the earnings have helped to support it, and you've seen the share price rising over time. So I think the key here is not so much the valuations, but the expectations around future growth and whether that's justified. And that's really the key when you're buying into a high PE ratio company, because if you're paying a premium now, then you do want to see greater growth in the future.
Your healthcare stocks.
Absolutely. We've seen Treasury Wine Estate being one of the dogs of the market over the last year. In fact, the stock down by about 40%. But I guess as an investor, when you're looking at a particular company and you want a share price to run higher, what you need is for something to change. If things stay the same, then usually the share price valuation should stay the same. So really you want something positive, a positive catalyst, and that can usually be in the form of a new product, a new CEO, or a new strategy coming in place. I think a lot of analysts have been holding off on their views on Treasury Wine Estate until it became a little bit clearer what Michael Clark's strategy with Treasury Wine Estates would be. He does have a very impressive CV. He's worked at senior roles in both Kraft as well as Coca-Cola, and in his role at Premier Foods, he did increase spend in terms of marketing as well as reducing the range in terms of the food products that there were. And it does look like a similar type of strategy may be coming forth for Treasury Wine Estates, in that there will be an increased marketing spend in terms of some of their premium and luxury brands that they're trying to push, and that we will see some of the lower end brands either being sold off or disappearing altogether. So the market really quite positive around some of the components of that introductory address to the market that we saw coming through from Michael Clark today, and the stock doing very well today, up by 7.2%.